11 days after the Plasma network launched its native token, XPL, the price hit a high of $1.69. Then, the floor fell out. The token plummeted 95%, bottoming out at just under 9 cents. For most retail investors, a chart looking like that means the project is dead. They cut their losses, moved on to the next shiny object, and assumed the network had simply failed. But this chart displays a glaring contradiction. While the red line tracks the token's collapsing price, the growing shaded area behind it tracks total value locked, the actual amount of capital deposited on the network. That number didn't drop. Instead, institutional players quietly kept depositing capital until it hit nearly $19 billion. $19 billion in deposits indicates a highly active network doing exactly what it was built to do. The market is valuing a functioning utility as if it were a defunct project. When retail panic pushes a token price into the dirt, at the exact same moment large-scale whales are aggressively using the underlying network, a gap forms. Spotting that disconnect between sentiment and utility is where the largest crypto opportunities hide. To understand that gap, we have to look at what Plasma actually is. Built by CEO Paul Fakes, it operates as an independent Layer 1 blockchain. Its architecture was designed with a single goal: processing stablecoin payments at scale. The development is backed by Tether, the largest stablecoin issuer in the world, and Peter Thiel's Founders Fund. That backing provides the project with technical competence and massive industry connections. The real draw for that $19 billion comes down to the absence of friction. On Plasma, users can send USDT across the network with zero transaction fees. Any necessary network execution costs can be paid directly in USDT. Enterprises can operate entirely within the Plasma ecosystem without ever holding the native XPL token. Removing the requirement to hold a volatile asset just to move stable capital solved an enormous headache for large financial operators. This utility drew $2 billion in liquidity on the very first day the mainnet went live in September 2025. The system is functioning as intended. It operates as an enterprise-grade back-end infrastructure for stablecoin whales, processing massive volume far away from retail speculation. Out of 10 billion max XPL tokens, only 1.8 billion are currently circulating. As transaction volume occurs, base fees are destroyed, reducing active supply. But burning a small percentage means little against the 8.2 billion tokens still locked away. Starting in 2026, the network is scheduled to begin massive token unlocks. Every time new tokens enter circulation, the value of all existing tokens drops, unless overwhelming new buyer demand steps in to absorb the sell pressure. The 95% drop from the $1.69 high was a mathematical reality check. The market aggressively priced in the future sell pressure coming from those inevitable unlocks. Right now, XPL trades near 8.9 cents. It has flatlined at the bottom of the chart, entering a quiet phase of consolidation, where the remaining buyers and sellers have reached a standstill. The critical resistance level sits at 12 cents. If trading volume pushes the price above that threshold and holds it there, it would signal a legitimate attempt at a broader recovery. The bullish case is built on fundamentals. With Tether and Founders Fund guiding development, and $19 billion in on-chain activity, the underlying infrastructure has proven its value. The bearish reality is structural. Buying XPL today means fighting the immense gravitational pull of those impending 2026 supply drops. For a smart entry, wait until the token's price action actively decouples from that unlock pressure, proving it can absorb new supply without collapsing. Let me know in the comments if Plasma's massive TVL makes it an obvious buy, or if the coming tokenomics will keep it buried. If this breakdown helped you see the full picture, hit the like button and subscribe for more. Moving $19 billion in stablecoins with zero fees is a significant technical achievement. But in crypto, technology alone is useless to an investor if the tokenomics are designed to extract their liquidity.